Picture a telegraph operator named Henry. It is Saturday, November 8th, 1890, and he is working the wire room at the city offices of a private bank on Bishopsgate. Late in the afternoon, a message comes in. He doesn't know the full content. Telegraph operators were not supposed to read the messages they transmitted, but the words he keys through, addressed to a partner of the firm from a correspondent in Buenos Aires, are enough to tell him that something has gone badly wrong. The bank is Barings Brothers and Co. The message is from Argentina, and by the time the sun sets on that Saturday, the governor of the Bank of England is being recalled from his vacation in Scotland by telegraph. The Chancellor of the Exchequer has received a note at his country house asking him to come to the city on Monday, and the most powerful private banker in England, Nathaniel Rothschild, has been quietly asked whether the Bank of France might be willing to lend Britain some gold. Nobody outside a handful of men knows any of this. The city is quiet. The weekend papers are running the usual commentary on trade and politics. The financial markets will open on Monday morning, and to all appearances, everything will be as it always is. What those markets do not know, what Governor William Lidderdale is frantic to prevent them from finding out before he has assembled a solution, is that Barings Brothers and Co. is the oldest and most prestigious merchant bank in the world. The sixth great power of Europe, the house that had financed the Louisiana Purchase and the Suez Canal and the Argentine Railway Network and the Canadian Pacific. That institution is insolvent. The story of what happened between that Saturday and the following Saturday, 7 days in November 1890, during which the entire architecture of Victorian finance was at risk of collapse, is one of the most instructive crisis narratives in the history of banking. It is the story of the first modern bank bailout, the prototype for every systemically important financial institution rescue that followed, and the moment at which the principle of too big to fail was first applied, consciously and deliberately, in the City of London. It is also, when examined carefully, a story about how the most prestigious institution in the world had been destroyed not by fraud, not by recklessness in any obvious sense, but by the very success of the business model that had made it great, concentrating the risk of an entire continent as capital flows into the books of a single private partnership. To understand how Barings had arrived at this position, you have to trace the decade of Argentine investment that preceded it. Argentina in the 1880s was, by the standards of Victorian emerging market investing, one of the most compelling stories in the world. The 1880s stand out as a period of totally unprecedented capital inflows into an emerging market at any time in history. The current account deficit, as a percent of GDP, averaged 20% from 1884 to 1889. The country was building railways, ports, and infrastructure at extraordinary speed. Its beef and grain exports were growing rapidly as the pampas were opened up by the new rail connections. Population was rising through European immigration. The structural story of Argentine development, cheap land, fertile soil, European-style institutions, growing export sector, proximity to British shipping routes, was not fabricated. Argentina was genuinely developing. The problem was the pace and the price at which British capital was being committed to that development, and the degree to which a single institution had become the channel through which that commitment flowed. Argentina absorbed roughly 11% of all new issues on the London market between 1884 and 1890, and an astonishing 40 to 50% of all lending that occurred outside the United Kingdom in 1889. And virtually all of it went through Barings. The firm had channeled approximately $140 million in British investment to Argentina between 1885 and 1890, primarily through loan guarantees and bond issuances. The relationship was so close that Argentina had effectively outsourced its sovereign financing to a single private firm. Barings arranged loans for the national government, for provincial governments, for municipal authorities, for infrastructure companies. When the Buenos Aires Water Supply and Drainage Company needed to raise $2 million in 1889, Barings underwrote the issue, meaning Barings committed to purchase any bonds the market did not take up. When the market did not take them up, Barings held them. They sat on Barings' books alongside the other unsellable Argentine paper it had accumulated. By October 1890, Barings held $8.3 million in devalued Argentine securities, including $4.6 million in unsold bonds like those for the Buenos Aires Waterworks, exceeding the firm's $4 million capital base and rendering it illiquid when markets tightened. The deterioration in Argentine conditions that made this paper unsellable had been building for years. From 1884 until the crisis hit, the monetary base grew at an annual average rate of 18%, inflation averaged 17%, and the paper peso had been losing value continuously. Interest payments were consuming an increasing share of government revenues, reaching levels where interest payments consumed 40% of government revenues by 1890. The gold premium on the paper peso, which measured the market's view of how far the currency had strayed from its official gold parity, had widened dramatically. Argentine exporters who earned gold pesos for their beef and grain were doing well. The government, which needed gold pesos to service its foreign currency debt but collected taxes in paper pesos, was doing badly. The arithmetic of a fixed exchange rate and a deteriorating fiscal position was pointing toward one outcome. The London market, reading the same arithmetic, was increasingly reluctant to take new Argentine bonds at prices that reflected the official fiction rather than the deteriorating reality. To finance its portfolio of Argentine securities, Barings had quietly borrowed around the market so as not to arouse concern. By the end of October 1890, it had accumulated a liability of $15.7 million. The firm's partners had been aware of the problem for months. A letter from Tom Baring to his cousin Evelyn Baring, dated November 6, 1890, 2 days before the Saturday meeting, reads as quoted in the Yale YPFS research paper from the Baring archive. "You always said that B. Aires would be the death of us, and I am afraid you were about right. We have, alas, been caught hopelessly locked up in various Argentine and Uruguay. That sentence, the private admission of a partner of the most powerful bank in the world that it was finished, was written 4 days before the governor of the Bank of England was told the truth." Barings had been managing its public image while its private correspondence confirmed the reality. The Saturday meeting was convened by Everard Hambro, a banker who was both a director of the Bank of England and had sensed from the discount market its behavior that something was seriously wrong. One informed insider, Everard Hambro, a banker and director of the Bank of England, sensed trouble and organized a meeting in his office with Lord Revelstoke, E.C. Baring, Francis Baring, and the governor of the Bank of England, William Lord Lidderdale. What Lidderdale learned at that meeting was worse than he had feared. Although not highly leveraged by some recent standards, having capital of $4 million and assets of $20 million, the bank possessed $8.3 million of toxic Argentinian securities. The assets exceeded the liabilities on paper, but the Argentine securities could not be sold at their book value, and the liabilities fell due on specific dates. Barings was liquid on paper and insolvent in practice. Precisely the condition that most financial crises produce, and precisely the condition that is most dangerous because it is not immediately visible. Lidderdale certainly thought that a panic would occur if they did not quickly respond. He was right, and the reasoning was spelled out later in academic terms, but was clear to him intuitively in that moment. If Barings' position became publicly known, other banks holding Barings' acceptances, the short-term bills that Barings had written on behalf of international merchants, would refuse to renew them. Every accepted bill Barings had in circulation would immediately become a claim on a bankrupt estate. The discount market would seize up. Other banks could not distinguish between their own exposure to Barings and their general exposure to the market, so they would restrict lending to everyone. The credit that kept the Victorian trade finance system running, the 3-month bills that financed shipments from Buenos Aires to Manchester, from Bombay to London, from Calcutta to New York, would stop being renewed. The global trade network that the accepting houses had built would freeze at the most critical joint, London. The Chancellor of the Exchequer, George Goschen, had his own reaction recorded in the historical archive. Meeting with Lidderdale on Monday, November 10th, before full details were known, Goschen reportedly said, "If it is Barings, 1866 would be a trifle compared to it." The reference was to the collapse of Overend, Gurney & Co. in 1866, itself the biggest financial collapse in Victorian London, the event that had set 200 firms bankrupt and paralyzed the city for months. Goschen was saying that a Barings failure would be worse. His assessment was shared by Nathaniel Rothschild, who later remarked, as the Wikipedia article on the crisis records directly, that if Barings had not been saved, perhaps the entire private banking system of London would have collapsed, which would have caused an economic catastrophe. What Lidderdale did between Saturday, November 8th and Saturday, November 15th, the week between discovery and resolution, is one of the most impressive examples of crisis management in financial history. And it was done under conditions of complete opacity because transparency would have destroyed the very thing he was trying to save. Meeting on Monday, November 10th, Goschen told Lidderdale that the government would not interfere on behalf of an insolvent house. However, recognizing the Bank of England's gold reserves had fallen to a dangerous low of $10.8 million, Goschen offered a chancellor's letter to protect the bank by suspending the gold requirement for banknotes. Lidderdale refused this offer. His reasoning was precise, announcing a chancellor's letter, the mechanism that had been used in the crises of 1847. 1857 and 1866 to suspend the gold standard in emergencies would signal to the market that an emergency existed. The signal itself would trigger the panic he was trying to prevent. He needed a solution that could be announced as a fait accompli, not a process that would leak during its construction. He went to Rothschild's first. Rothschild's negotiated a $3 million gold loan from the Bank of France against treasury bills, and William Lidderdale of the Bank of England obtained half that sum from Russia. The gold swap with France and Russia was the move that made everything else possible. It replenished the Bank of England's reserves to the point where it could extend credit to Barings without breaching its own gold requirements. The Banque de France agreed to swap $3 million in gold for British Treasury bills, and Russia exchanged a further $1.5 million in gold for exchequer bonds. Additionally, Russia promised not to withdraw its existing $2.4 million deposit at Baring Brothers. With the reserve secured, Litterdale moved to assemble the guarantee fund. He approached the major London banking houses one by one, Rothschilds, Glyn Mills, the joint stock banks, and asked each to contribute to a syndicate that would guarantee Baring's liabilities. The bank's $1 million was quickly matched by $3 million from the major financial houses. In little more than a week, the contributions of the joint stock banks had topped up the fund. The Barings rescue was announced on Saturday, November 15, 1890. The Bank of England provided an advance of $7.5 million to Barings to discharge their liabilities. A 4-year syndicate of banks would ratably share any loss from Barings' liquidation. The guarantee fund of $17.1 million included all institutions, and some of the largest shares were assigned to banks whose inattentive lending had permitted Barings to swell its portfolio. The structural elegance of the solution deserves attention. Litterdale had not simply lent Barings money. He had organized a syndicate in which every major London bank had a stake in the outcome, making the rescue a collective commitment by the entire city rather than a unilateral act by the Bank of England. The old firm was split into a recapitalized good bank, Baring Brothers and Cumber Limited, which took over the still profitable trade finance, and a bad bank that retained its name and its toxic assets, managed by the Bank of England. The Barings partners agreed to this arrangement, delivering powers of attorney over their property, avoiding the danger of a fire sale. But, as unlimited liability partners, they were still expected to cover any losses. The good bank, bad bank split that Litterdale designed in November 1890 was reinvented in 2008, when governments across the Western world faced analogous problems with their own systemically important institutions. The principle is identical. Separate the viable ongoing business from the toxic assets. Allow the viable business to continue operating. Manage the toxic assets down over time rather than forcing an immediate sale at distressed prices. Litterdale had invented the template that Hank Paulson and Alistair Darling would apply 118 years later, under different names and with much larger numbers, to the same fundamental problem. The announcement of the rescue on November 15th calmed the market immediately. The past month will long be remembered in the city. The downfall of Messrs. Baring Brothers, perhaps the greatest firm of merchant bankers in the world, would alone have sufficed to keep it in remembrance. The Economist wrote those words in retrospect, because at the time, the downfall had been prevented. The market did not know how close it had come. The discount rate was raised to 7%, but was not held there long. Credit conditions normalized within weeks. The global payment system continued to function. But the rescue of Barings was not a rescue of Argentina. The intervention provided negligible support to Argentina, which defaulted on $48 million in debt, 60% of global sovereign defaults in the 1890s, triggering an 11% GDP contraction in 1890 to 1891. The contagion that the rescue prevented from reaching London hit the periphery in full force. Sovereign debt prices for Brazil fell 31% between July 1890 and June 1892. Chilean bond prices declined nearly 9% in the first year after the outbreak of the crisis. As the Berkeley academic paper documents from the spread data, sovereign yield spreads for Central and South American borrowers increased by nearly 800 basis points in the year following the crisis. The capital flows that had been financing Argentine railways and Brazilian infrastructure and Chilean mining operations stopped. The boom years were over. The asymmetry of the rescue, London protected, Buenos Aires sacrificed, was noticed at the time and has been studied extensively since. The Bank of England-led rescue of Baring Brothers was designed to secure the stability of the London market. Only secondarily was there any concern with the plight of Argentina. The pattern of protecting the financial center at the expense of the periphery that had borrowed from it is not a unique feature of 1890. It recurred in the 1994 Mexican peso crisis, the 1997 Asian financial crisis, and the 2010 to 2012 European sovereign debt crisis, in each of which the management of contagion was calibrated to protect the creditor's financial system before the debtor's economies. The logic is not cynical, it is structural. The institution with the capacity to act is the institution at the center. The people it can protect most effectively are the people in its own system. The critics of the rescue were not silent in 1890. Critics, including contemporary left-wing figures like Henry Hindman, argued the rescue exemplified elite favoritism, using quasi-public central bank resources to bail out private recklessness from overextended Argentine loans, fostering moral hazard and eroding market discipline without public oversight or transparency, as operations were conducted in secrecy to avoid panic. These arguments were structurally identical to the arguments made against the TARP bailout in 2008, against the Bear Stearns rescue in March 2008, against the AIG rescue in September 2008. The moral hazard argument that rescuing institutions from the consequences of their own risk-taking removes the incentive for prudent risk management is permanently valid. It is also permanently incomplete. The alternative to rescuing Barings in 1890 was not a clean market resolution, in which reckless investors lost their money and cautious investors prospered. It was the freezing of the London acceptance market, the collapse of the trade credit that financed shipments across the world, and a depression whose scope would have extended far beyond the creditors who had foolishly bought Argentine bonds. The innocent and the guilty would have suffered together in proportions the market could not have distinguished. Litterdale chose to rescue. He kept the choice secret until it was complete. He made the guilty parties, the banks that had imprudently lent to Barings as its exposure grew, share in the guarantee fund rather than letting the Bank of England bear the cost alone. He separated the good business from the bad assets. He did all of this in 7 days without a legal framework for any of it, without statutory authority, without public announcement until the solution was assembled. The operation was the work of a former partner of Rathbone Brothers, a private banker who happened to be serving as governor of an institution that was itself a private bank, managing a crisis in a market that had no regulator, no deposit insurance, no capital requirements, no disclosure rules, and no mechanism for preventing the next Barings from accumulating $140 million in exposure to a single emerging market in the first place. The 1890 rescue established a set of practices that central banks have been refining ever since. Work in secret until the solution is ready, get private sector participants to share the cost, divide insolvent assets from viable businesses, announce the resolution as a fait accompli. Ben Bernanke, who explicitly cited the Baring crisis in his academic work on bank panics before he became Federal Reserve Chairman, applied the same template in 2008. The specific numbers were different. Billions rather than millions, global rather than British, with legal frameworks and press releases rather than handwritten notes to chancellors. The architecture was the same. Barings Brothers survived the 1890 crisis in its restructured form. It continued as a merchant bank for another 105 years. Then, on February 26, 1995, a 28-year-old derivatives trader named Nick Leeson had accumulated losses of $827 million in unauthorized positions in Singapore, and the bank discovered it had no capital to cover them. The Bank of England spent a weekend trying to organize another Litterdale-style rescue. This time, as the previous script in this series documents, no consortium would put up the money.